They want to know about writing off improvements made to their rental property. Is that allowed?
Yeah. The it depends here is whether it gets expensed or capitalized. And it depends on the type of improvement it is and how much it is. Generally, $4,000 is like a threshold. If you're doing structural improvements, then that's going to be capitalized because you're physically adding into the overall capital structure of the building. If it's I repainted, then it depends on how much. Are we doing a whole thing where it's the whole house inside and out, or am I repainting a room that's $800? So at that point, it starts to get a little more granular as far as how you do that. So one of the things that's going on in Congress right now is a negotiation over bonus depreciation. So back in 2017, when the first version of the Trump tax reform went into effect, we got 100% bonus depreciation for all kinds of stuff. And the reason or the rationale for doing this is they wanted to incentivize businesses to buy into equipment and capital and factories and all this kind of stuff. So basically, everything short of 27 and a half year real estate, basically everything that was under that, like 15-year property, 7-year property, 5-year property, 3-year property, that all became bonus depreciation of 100%. And so effectively, it was the same as just writing it all off in the year that you bought it. So there was no difference between expensing and capitalizing. Now, as the Tax Cut and Jobs Act gets closer to expiration in 2026, that bonus depreciation has shrunk because I don't want to go into all why that happens, but basically we're losing 20% a year. And right now we're at 60% for last year. We're at 60% for the bonus depreciation. What they're talking about right now, and one of the things Trump said in one of his speeches was that he wants to 100% bonus depreciation for all assets purchased after January 20th, 2025. Now that has not passed yet, but that's in the active discussion. So if assuming that does go back into the code, the tax code, then we'll be back into the situation we were in where effectively there's no difference between capitalizing an asset and just buying it and expensing it directly. Hopefully that does pass in whatever bill they end up on. I think it will. And yeah, that'll be great for anybody who is spending money on capital stuff like real estate improvements. That is a case where eventually it might not depend, but right now it does. Oh, we got a question here from Melissa. Does that mean your kids' income wouldn't need to be reported on your taxes since you claim them, or they have to file a separate tax return? They would have to file a separate tax return, yes. So anybody who has earned income, all right, it depends on the state. So if you are underneath the threshold for a standard deduction, then you might not have to file at all. But there's differences between the federal not having any taxes and the state. And so you do have to file because there's a state obligation. Or if you're over the standard deduction and you're playing the IRA approach, then then you still have to file that because you need to tell the government, hey, we were over the threshold, but now we're under because of the IRA contribution. But yeah, the kids file their own tax returns and they're still dependents. They're still claimed by the parents. And yeah, they're just in a zone where they don't have to pay any tax. Also, people sometimes ask about the kiddie tax, and that's for investment income. That does not apply to earned income. So as long as their investment income isn't crazy, then you don't have to file kiddie tax issues. All right.